Now it is. Okay. All right. So Chapter 9 we'll introduce today. This is really, we're going to start getting into cost value of money, and so time value of money associated with current liabilities and such. And then we'll finish the course with property. I mean, depreciation, depletion, and amortization. So we'll have Chapter 10 on property, plant, and equipment, which is depreciation. Then we'll do some more on depletion, which is natural resources. And then we'll finish the course here in a surprisingly short few weeks on intangibles. And so those are the 4 chapters that will be on the final exam. And as I said, the final exam is already posted, so if you want to take a sneak peek, feel free to do so. Okay? All right, so Chapter 9. Oh, the other announcement that please remember, Thursday night is the meet and greet, or whatever it is they're calling it. So that's Thursday night, business attire. Come, there's a very good selection of firms. EY and KPMG are both coming, and so please come. I think that would be very good. All right, liabilities. These are future sacrifices. Probable as to what is expected, the obligation as to what are you legally required or bound by contract or even moral responsibility to pay. So there are differences between legal liabilities. These are your contractual types as opposed to equitable and constructive liabilities. There's no legal requirement. You pay vacation. You promise your employees bonuses at year end. That's the difference. That's an equitable liability. So you're not under most companies nowadays. Bonuses are discretionary. There are very, very few companies out there that have a set contractual formula for year end bonuses. So it's a little unusual, but you shouldn't be confused. So current liabilities, as we talked about when we were doing the classified balance sheet, is everything that is due and payable within a year for purposes of this class and most companies that you go to work for. Very, very few organizations out there have an operating cycle longer than a year. So that's what we're looking at. So we have contractual obligations, accounts payable, notes payable, long-term debt that is current, dividends and such, property taxes. And then we have operating activities, the stuff that we do on a daily basis. We pay payroll, we withhold taxes, we withhold union dues, we pay people for sick leave and vacation, we incur sales and use taxes on our operation and such, and then we pay federal income tax. And then there are also loss contingents. And so we'll talk about the definition of what is a loss contingency that we have to then accrue for. And we have warranties, we have premiums and coupons, we have contractual guarantees and such. So those all become current liabilities. So how are they valued? They're valued at their face value. I mean, you get an invoice from your vendor and that's your value. There is going to be, however, some transactions that we enter into, and we'll be talking about those when we get into problems on Thursday, where it's the present value of the required future payments. And a good example of that is a non-interest bearing note. All right? We go out and we buy something, and we in turn sign a promissory note to pay for whatever it is we bought in 90 days. And there is no interest charged in that note. Well, U.S. GAAP requires us to accrue the interest. So if you're buying an item for, just for simplicity's sake, $100,000, and we're going to pay it in a year's time, well, it's not worth the $100,000 today's dollar, because there's some sort of time value of money between now and then. If you don't believe that, I want to borrow money from you. So I'll pay you back at graduation, I promise. You're going to add the interest. You're going to accrue interest. So what you're going to do is you're going to take it down to its present value at the time of the transaction. And then between now and the actual point where you pay off the liability, you're going to accrue interest.
Okay, but is the person that's paying off the liability going to pay the interest?
Well, there is no interest in it. If I'm promising to pay you $100,000 a year from now. If we had an implied 10% interest rate, that would be $91,000 today, or $90,000 today. Okay, and I'll pay you $100. So I booked the transaction at $90. That's where how much I record it for. So, because that's effectively what I'm buying it for, is today's dollar value. So, and we'll get into examples here in a second about that. But, all right, so accounts and trade payables, these are issues that, this is the bulk of your current liabilities. It's depends when you book it. Once again, the FOB, free on board, destination, or shipping point. Because if it's destination and it's in transit at the month end or year end, it is not, doesn't belong to you. It belongs to the seller. It doesn't belong to you until they back that truck up to your loading dock and you take possession of it. That's FOB destination. So, but however, if it's FOB shipping point and it's in transit at year end, you need to go through and determine all of those sometime before you finally close out your book for the year. Because those belong to you the minute it left the shipper's warehouse. Okay? So that's a key adjustment that is done at the end of every year. A note payable is a promissory. These have interest or non-interest bearing, and this is where the bulk of our time value of money calculations come into. It is a legal document. They can take you to court. It gives them a priority over unsecured creditors. So the people that you owe trade accounts payable to stand in line behind everybody that has a note. So notes are very common out there, especially in international transactions, because it is collectible in a court of law. And then I've already talked about this, the difference between interest and non-interest bearing notes. So this one we are going to discount back to the current value as of the date of the transaction. And whether it's an installment and we have to go to the table where we have annuities, or it's a single payment, we value it at its present value. Okay? And that's how we'll book the transaction. And that'll become obvious. All right. So interest is just straight up. What's the interest? You accrue the interest over the life of the note, and then you pay the note and interest at the maturity date. So here's an interest bearing, $7,000, 12% for 30 days. So on a 360-day year, that's 1% per period. So $70 worth of interest you have to accrue at the end of the month. And then the next day you pay $7,070 to cover the whole transaction. All right? This is where it gets tricky. So what about a non-interest bearing note? So here's a non-interest bearing note. A 90-day, $10,000 non-interest bearing note. It's going to be discounted by the bank on a 12% basis. So when a bank does this, they don't give you the $10,000. They take the interest up front. And I think I've mentioned that in this class. Don't do this. Because what you're doing is paying a higher than 12% effective interest rate. You understand that? Because what are you borrowing truly? You're borrowing the $9,700. So if you divide this $300 worth of interest by the 9,700 that you actually in fact received when you signed this promissory note, you're going to wind up with more than 12% as an effective interest rate. Okay? So this is how it's booked. You book a discount on notes payable as a debit. It's a contra liability account. So at the date of signing, you owe 9,700, and at the maturity date, you'll own the whole 100,000. So at the end of June, you then book the interest expense, removing the discount on notes payable, and then on the same day, you pay off the full $100,000 or $10,000 note payable. All right? So here's the effective interest rate then. So if you divide the 300 by the 9,700, you get 3.09%. But that's for a 90-day period, or 1/4 of the year. Multiply that by 4, and rather than the bank charging you 12% like you thought, you were really being charged 12.36%. So don't do these. And you have the option, just borrow the whole $100,000 and say, I'll pay you $100,300 or $10,300 90 days from now. Just sign simple interest notes as much as you can. Line of credits are very common once again in international transactions. So you'll set up an LOC. It's like borrowing money. You'll set up an LOC with your financial institution. You'll issue it to the vendor in China. And then when the vendor comes to the port with all of the export documents and the goods, they at that point can, without any further permission from you, they can collect that note from your bank. So once they fulfill the obligations. Now, notes payable, accounts payable actually requires me as the payor to actually send you a check. Okay. This, I don't have, once they fulfilled the obligations of the order, they can collect this out of my bank. So my bank is holding this, in essence, in reserve on behalf of this vendor. So they always make sure that I've got enough to cover the LOC. All right? Very, very common in international transactions. Okay? Commercial paper, I'm just going to generally talk about it. Big corporations, and when we're doing the classified balance sheet, and we talked about commercial paper, these are short-term. A lot of times they're just overnights. They may mature in longer than, but if you've got some excess cash, you can buy commercial paper from large institutions. So it is a short-term liability. So as long as it matures less than 9 months from the issuing date, it does not have to be registered with the SEC. So, and you can find them. You can call your banker and tell them you want to put some money in some commercial paper, and they'll say, well, we've got some IBM, we've got some Apple, we got this, that, and the other. It's always top blue chip style companies that issue this stuff. So, long-term debt. A portion of long-term debt is a current liability, because if you're making a mortgage payment on a monthly basis, a portion of that monthly payment goes to pay down principal. So you have to create an amortization table where you take the total obligation, multiply it by the interest since the last payment that's going to accrue on this note, subtract that from the payment, and I'll show you an example of this on Excel on Thursday. These tables are very easy to do. Once you get them set up, you can do 30-year mortgages in about 2 seconds. It doesn't take long to do them. And then the rest of it pays down the principal. So the obligation goes down a little bit. It goes down very, very little early in the note life because their obligation is very high. But once you get to the end of the note, if you've got a 5-year car payment, once you get down to the 4th and 5th year, the total amount owed on that is very small. So when you multiply that by the effective interest rate for the 30 days, 31 days since you last made a payment, the majority of your payment then goes to principal. Well, those principal payments.
The more goes to principal?
Yes, yes. And I'll show, it'll be obvious. It's just something that you all absolutely, as junior accounting majors, you need to know, because amortization tables they just permeate all transactions. So I'll go through and I'll show you how to set one up very, very easily. It's similar to when we were doing bond amortizations. So it's very similar to a bond amortization. So, all right. So, but the next 12 months payments, the principal column is a current liability. You're going to pay those principal payments in the next year. So you've got to list it, current portion of note payable, up in the current liability section, and then subtract it from the total amount owed on the mortgage for the long-term liability. So this is and corporations, not even small to medium-sized corporations, will have dozens of these notes. So this is an adjustment that you make every month, is to reclass that up into current from long-term. So monthly, you just adjust your little 12-row sum thing down one row every month and then book it. It's not difficult to do. Okay, let's see. Okay, this is another good one. You've got a long-term liability, a bond, a note, something that is going to mature now within the next 12 months, which by definition makes it a current liability. All right? At that point, if you have a reasonable expectation that you're going to refinance this, so you're going to go back to your bank and say, I want to take, this note payable and this little short-term note payable, and I want to roll them all into a 5-year term note. If you're going to refinance it, you do not have to list it as a current liability. If you have, at the balance sheet date, a reasonable expectation of rolling all this into another long-term note, which is very common, people do that all the time, then you can reclass it as long-term. Okay? Yeah, this is an odd little deal. I'm not going to worry about that one. All right, dividend payable. Dividends, remember, have 3 dates associated with it. The declaration date, the date of record as to what stockholders are going to receive it, and then the actual payment date, right? The declaration date is when the obligation gets put on the books. So the minute the board of directors meets and approves a dividend, it doesn't matter if it's going to be 6 months down the road when they actually pay it, that is when it becomes an obligation, all right? And you book it by reducing retained earnings and hitting dividends payable, okay? Some companies use a dividends account, debit dividends and credit dividends payable. This one, for some reason, is hitting retained earnings directly. Property taxes, these are accrued. Your book is going to do examples where property taxes come in on an annual basis, but normally you estimate that and do it monthly in real life. What is the estimated property tax bill going to be, so that you can spread that out over the year? We'll do an example of that. Accrued liabilities, we've been doing this. This is one of the deferred expenses, accrued expenses that we do at month end and every time we close out books. You've been doing that since Chapter 3. So payroll is the most common one. People work up until month end. You owe them the wages. You properly match the expenses of wage expense to the revenue that they've been generating for you. And you need to do all of the withholding and such. So that's one of the things in this chapter is to introduce you to the full payroll transaction. Because you've all received a paycheck, right, at some point in time? Has anybody not received a paycheck ever? Don't be embarrassed. I mean, you know, thumbs up if you never had to work. All right, so out of your paycheck comes withholdings. You pay federal income taxes, you pay FICA, and you pay FUTA, which is Social Security in its broad terms. So you pay all three of those out of your check. The employer matches the FICA and the FUTA. And then they also pay state unemployment, or unemployment, a portion to the federal government and a portion to the state, depending upon their experience. So the more people that you have as a corporation who actually go out and file for unemployment claims, the higher your rate goes. So the federal rate is set, but the state will start charging you more and more, which is why employers on occasion get kind of mean and then fight unemployment. Because if you terminated somebody for cause, you do not have to pay them unemployment. But I always thought that was a little cruel in my mind. I didn't really. Yeah, I mean, you're paying it anyway. But it will increase your rate. So if you have a whole bunch of that. So anyway, I'll digress. So we're going to go through and do examples of how to calculate all of this. So the federal unemployment, this is the 6%, and it's only for up to $7,000. So normally the first quarter of every year, or certainly by the second quarter of every year, the employers have met their FUTA responsibilities. Their FICA responsibilities moves up every year, and I don't even know what it is anymore. It's probably, I don't know, $180 some odd thousand. It used to be, when I first started working, it was 22 grand. It's nice. 22 grand. So in public accounting, you used to get paid, well, Pete Marwick used to pay you time and a half for overtime. So you used to make a lot of money during busy season. And so we used to meet, you know, by about Thanksgiving at the latest. As staff people, your FICA, your FUTA would go away. You wouldn't have to pay it anymore, which was nice. Because then it gave you money for Christmas and New Year's. So, and then there are all sorts of contractual voluntary payroll, union dues, the health insurance, the dental insurance, vision, accidental death, life insurance, all this other stuff that employers on a regular basis take out of paychecks. And then they have to pay that because all of the things that you remove from an employee's paycheck, you're paying to someone else. All right, you're paying it to the federal government for the FICA, the FUTA, and the FICA, the FUTA, and the withholding. You're paying to the insurance companies for all the health and all this other stuff. So that all goes elsewhere. So there's a whole slew of payables that you have to set up when you're making payroll. So this we'll talk about, and it's not difficult, but this is one of the final exam questions, is payroll. Let you know. Compensated absences, same thing. You know, if you're going to pay somebody vacation, holiday, sick leave, things like that, you need to accrue that. Because that is a obligation that you're going to have that for most companies they have to take within the next 12 months. So that's a short-term liability. We'll talk about that. All right. Here's an example real quick. You have 100 employees. They're each given 12 days of vacation per year, and they each make $200 a day. So you're running a sweatshop someplace. Nike. Multiply that out. That's an obligation on an annual basis of $240,000. If you were going to accrue it once a year, which I highly recommend you not do, I would do this monthly, then it would be a debit to salaries expense and a credit to the liability for compensated absences for the $240. If you did it monthly, it's 20 grand a month That makes more sense. So. And then when they take the actual vacation, well, this is a raise. Then you, assuming everybody took theirs on an annual basis, you pay them their payroll as well as the little raise here. This is a really bad example. I'll do a better example on Thursday. Bonuses, the same thing. If you've got a contractual obligation of bonuses, even if it's a discretionary, if you really have a reasonable expectation, management knows that it's going to pay a bonus, then you need to accrue it into the proper period. Because the bonus, the revenue being generated that then allowed you to pay the bonus happened in the year, then you need to get the bonus expense in the same year. So that's what this is for. So that's also a salaries expense. Sales and use. What's the difference between sales and use? Anybody know without reading the slide? Sales tax is something you collect from a customer. Right? You go into a store, H-E-B, you buy a loaf of bread. I don't know if taxes are charged on loaf of bread, but let's assume they are. Then they collect it, they give it to the state. All right? So, if you buy something under a tax-exempt certificate, because you don't have to pay sales taxes when you buy the truckload of bread, but if you use it in the business, you allow employees to eat bread for free as a bonus. You then have to pay because you are now the final consumer of that product. You have to accrue it as a use tax. A more common thing is that, once again back to aerospace, is that we buy solvents, all right, to clean aircraft parts with. Well, that's part of our manufacturing process. We don't have to pay sales tax on it because we'll charge sales tax when we sell the parts to somebody, right? So if we use up barrels of solvent, but we also use that same solvent to clean our machinery or to clean our floors or clean anything in the factory. That's now a maintenance expense, and we have to accrue taxes on it. Yes?
So if the business uses it, then you do have to pay.
If you're the final consumer of the product, then if you're reselling it, it's a sales tax. And you don't have to pay on the items that you resell. But if you then consume it in your business, then you do have to pay taxes on it, and you accrue it because the people that you bought it from have already given it to you for free, right? They didn't charge you sales tax to pay the state of Texas. So this one is a big push. This is what the auditors look for. When they show up at your factory or your place of business, they're looking for use tax because this one's easy. Every invoice, you've got this number listed. This one's easy. They walk around and they look for stuff that you consume. All right? Or they compare what you sold with what you bought. And they go, where'd the rest of it go? Somebody steal all this? Well, if they stole it, you don't have to pay taxes on it. But if you used it up in your business, you do. And states are very, very aggressive in charging taxes. Very aggressive. My favorite is the state of Michigan. The state of Michigan charges sales tax on alcohol consumed within the state borders of Michigan, as do most states. Well, they went out one day and made a calculation. I would have loved to have been in the meeting when they came up with this idea. I bet the whole table just big smiles. They determined that people were consuming alcohol in aircraft flying over the state. And they made a calculation of every airplane, every airline that transits the state of Michigan, and they sent a sales tax bill to every one of them. That was just brilliant. It failed in court, but I mean, what an idea. It was great. Yeah, they attempted to collect sales tax on every little tiny bottle of alcohol served in every airplane that was within the state borders of Michigan. Every little can of beer. Anyway, they get very aggressive with this stuff. Income taxes is another thing you have to accrue, and we've been doing that even on the last midterm, so income tax expense. Unearned revenues, deposits that you get from customers, the airline business, once again, huge number on unearned revenues, deferred revenues, because people pay for their tickets when they buy them, not when they fly. It also is publishing gift certificates. This is where your gift cards for iTunes go that you get from Aunt Matilda every Christmas. It's it's a liability, unrecorded. It's an unearned revenue until such time that you use it. Okay? All right. All right, contingent liabilities. We've alluded to this, but this is where something is going to happen in the future that is going to create a liability. So warranties are the big one here. So it can be, you've got some sort of probable loss in the future, whether it's from litigation, from environmental, you're in a tax dispute, you've got some government investigation going on for the Foreign Corrupt Practices Act, and you're going to lose. And so what does a contingent liability have to meet in order to book it? There's two things that have to happen. You remember? I'm sure we've talked about this.
Wait, for this, for warranty, you won't be able to know if you're going to get revenue off the warranty or you're going to...
Yeah, but warranties, you can estimate because you've got past.
What if people never end up using it?
Well, then you adjust your estimate. Yeah. So, all right, for contingent liabilities, it has to be probable. And go back to the litigation. That's the easiest example. You're in a court case. Somebody's suing you. Your attorney now tells you that you're going to lose. Right? Your CEO got, during cross-examination, admitted to polluting the environment. He was stressed and got all confused and goes, yes, we did it. We were dumping the chemicals in the river. So now you're going to lose. That's probable. But it also has to be reasonably estimatable. All right? It has to meet both criteria. Your attorney knows you're going to lose, but he cannot tell you, he or she, cannot tell you whether you're going to lose 10 million, 100 million, 10 billion, no idea how much. At that point, it's not a contingent obligation. It has to meet both criteria. So it has to be probable, it is likely to occur. Even if it's reasonably possible, you do not have to book it. If it's remote, you certainly don't have to book it. All right? So it has to be probable and reasonably estimatable. Both. And at that point, you have to book the liability. And if it's going to be short-term, you put it into a current liability. If it's going to be long-term, you put it into a long-term liability. Okay? You know you're going to lose, and you're going to be paying the plaintiffs $1 million a year for the next 10 years. Well, the $1 million is a current, and another $9 million is non-current, long-term. Okay? So here's is the future event probable? No. Then there's not even a reasonable possibility. You don't even have to disclose it. If there is a reasonable possibility, but it's not probable, in other words, it's in that second layer of definition, then you have to disclose it. If it's probable and you can reasonably estimate it, then you have to book it on the balance sheet as a loss for that current period and create the liability. All right, here's our warranty. We'll just talk about it. Accrue it is the most common method. Once again, matching revenues with the expenses that were incurred. So if you offer a warranty, make an estimate, and then create the liability. All right? So selling at 200 machines, you recognize an average cost of warranty cost of $150 per unit. You sold 200 units, that's a $30,000 warranty expense. You then put in an estimated warranty liability so that when you actually have to fix or replace or repair a machine, you don't hit an expense account. You just start reducing this liability by whatever it is. You took it out of inventory in the case of a replacement, or you sent a service technician out there and you paid them cash in payroll. All right? So that's easy. Let's see. Not going to worry about that one. Not going to worry about that one. Premiums and coupons. Premiums are actual items that you get for buying something else. You've all done that. Right? You've all gone to McDonald's and gotten a toy. Don't lie to me. I know every one of you have got a Happy Meal toy somewhere in your boxes. All right? That's a premium. You're buying something up front to give to your customers when they fulfill some sort of purchase. All right? Well, when you book that, when you buy all these little toys, in the case of McDonald's, you put that into premium inventory and you take it as an expense as you distribute them to your customers. A cash rebate or a coupon is different. Excuse me, I'm going to sneeze. Coupons, you need to estimate how many are going to be redeemed, because you print up literally millions of these things in magazines and bulk mailings and newspapers and stuff like that, but only a very small percentage of them actually get redeemed. So you make an estimate up front and you book the liability at the date of the coupon being issued. Okay? So they say, here you go, you're selling cans of spaghetti. If somebody goes out and cuts 30 labels off of your canned spaghetti, they'll get a fork. And the cost of each fork is $2, and you estimate that only 60% of all the labels that you ever sell are going to be redeemed. So when you buy the thing, it's inventory of premiums. This is a current asset. You pay cash for the forks. You then sell 300,000 cans of spaghetti, and at that point, you expense what you estimate the liability to be. So 300,000 times the $2 forks times the 60% gives you the 12%. Then actually somebody comes and redeems them. You then take them out of that estimate. This is your current liability. You reduce the liability and you reduce the current asset by the 150,000 forks that you sent out. All right? So pretty simple. And that's that.